I'm joined by my esteemed panelists.
Oh, shit.
And I'll start maybe from your right to left. First, we have Boale Odumare Adeoye from AFC. We have Besam Soa from the Islamic Corporation for the Insurance of Investment and Export Credit. We have Pradeep Reddy Badam from Western Premium. Martin Prus from Asset Manager 91 and also Fund Manager of Emerging Africa Infrastructure Fund. And finally, Yansik An from Citibank. Let me probably start by just setting a little bit the tone for the discussion. And I'll start with just giving you a quick statistic that is really related to just a part of infrastructure. No? At present, there are more than 600 million people in sub-Saharan Africa who are not connected to the grid or do not have power in their homes. At the current pace of electrification, over 500 million people will still not be connected to electricity by 2030. I think the conclusion is definitely that the pace of electrification in Africa needs to change. And there's several estimates around there. One of them is that this will require investments of about $200 billion over the next 6 years. Again, this is just a part of infrastructure, but if you talk about transport, about water and sanitation, social infrastructure, digital infrastructure, there are challenges all around. And this is probably a good starting point for the discussion. In order to frame the discussion, we're going to start basically with an assessment of the progress and challenges in Africa infrastructure, and then we'll switch to a bit more forward-looking, some of the solutions that we can work on, or that my colleagues here in the panel are working on from their respective institutions. So maybe Martin, if we start with you. From an asset manager perspective and Emerging Africa Infrastructure Fund that we at IFC have co-invested with you quite a bit in infrastructure in Africa. What is your view in terms of progress and the challenges in infrastructure?
Yeah, good afternoon everyone. So my name is Martijn Proos. I work for 91. I'm co-head of Emerging Market Alternative Credit, and we are the day-to-day fund manager for the Emerging Africa Infrastructure Fund, which is a blended finance vehicle backed by 4 European governments and then levered through a mix of DFIs, commercial banks and institutional investors. We have been going for well over 20 years, and we have about an investment portfolio of about $1.4 billion on the African continent in privately owned and managed infrastructure projects. So we have been going for 20 years. You know, the overall challenges on the continent, I think they, I can talk this 2 ways, you know. I'm going to start a little bit with the challenges at the moment. So we had a very long period of low interest rates, African markets having access to international capital markets, commodity booms, and relatively low debt to GDP levels in those economies. Over the last decade, and especially the last 5 years, that picture has changed quite a bit. So we see some challenges, obviously, with governments being high levels of debt and a number of countries facing debt distress. Inflation, higher cost of interest rates, or interest rates have gone up, you know, all have had an impact on the overall investment environment. But we have been there before. And at the same time, you know, if I look at my own, the fund that we manage, you know, we grew 15% year on year last year. We had our record year in terms of new commitments on the continent. There's great opportunities in digital. There's great opportunities in the energy transition. We are backing a lot of renewable energy projects which provide low cost power. We see battery technology cost coming down. We are about to close our first solar PV battery storage project without any form of blended finance or subsidy. So all very exciting to see. We see opportunities in the C&I space. And actually, despite all the challenges that we just mentioned, the portfolio is holding up quite nicely and shows good signs of robustness.
Thank you, Martin. Bowale, maybe we turn to you from a DFI perspective. What are the challenges that you see?
Thanks. And I would like to highlight the fact that, well, the Africa Finance Corporation was established in 2007 to be an infrastructure financing institution that invested in projects and is a Pan-African organization. One of the things that was established quite early was that there wasn't enough of a pipeline of bankable projects. And so with every challenge, we like to look at it as an opportunity. And so one of the things that we did from the onset was to establish a project development unit. And what the team did was to really put in the early stage risk capital and expertise to help the projects to become bankable. And so we kind of take each challenge and we try to look for solutions for that. And we see ourselves as a financial solutions provider. One of the other challenges is that it takes a number of years, 7 to 10 years on average, to see a project from concept to financial close. There's a lot of hurdles in terms of regulatory, the legal environment, in terms of pre-feasibility, feasibility studies, and also in terms of getting the lenders on board, and all the other financing partners across the spectrum. But however, the equity investors and the lenders investors each have a different criteria. One of the things that we have done to sort of overcome that obstacle on a project-by-project basis is really looking at the equity-first financing and seeing how we could de-risk the project with the early-stage project development alongside the equity investments, and then get the project through to the, through the hurdle of the riskiest part of the project. Once the project has been de-risked and has gotten to the commercial operations phase, we then say lenders can come in because the project has been de-risked. Of course, there's a lot that needs to be done. You talked about the infrastructure gap and how much needs to be invested over the next 5 to 10 years. And obviously, that gap is not being met. So how do we sort of catalyze additional financing from other investors, sovereign wealth funds, pension funds? And that's something that we continuously look to bridge.
Oh, excellent. Thank you, Bowale. Jacek, maybe we turn to you. You work a lot with sovereigns, with governments. What type of challenges do you see in that space?
Yeah, thank you, Enrique. Just to give a little bit of introduction about myself and what we're doing. So I'm heading a Sub-Saharan Africa business in export credit agency, DFI, and multilateral agency-supported financing at Citibank. So we offer mid-term and long-term financing solution to sovereigns, corporate, and FI client. And Citibank, we are one of the most active international banks present in Africa. We have a local presence in 15 countries in Africa. So yeah, we are very, very active in the region. So I think when it comes to the developing of infrastructure, especially large infrastructure project, including road project, hospital, a railway, a port, and airport. Those kind of infrastructure project quite often requires government support, either directly or indirectly. And one of the key challenges I see when it comes to the infrastructure, large infrastructure project, is the high cost of the borrowing for the corporates and sovereigns, as well as a relatively short term of the loan. So that really prevents or even deter the government or corporate from making large infrastructure project development in the region. So I think that is one of the key challenges I've seen for many sovereigns and corporate in the region.
Oh, excellent. Thank you so much. Pradeep, if we could turn to you, maybe with a private sector view. You also have advised several sponsors and are, of course, a private sector investor. What type of challenges do you see?
Sure. Firstly, thank you very much for having me. I'm Pradeep. I represent Western Premium, which is a company based out of Ghana. We have offices in Ghana and South Africa. What we do is basically physical asset managers. We provide industrial equipment to some of the large infrastructure companies based out of Ghana and across Africa. With regards to challenges, I think it's important to look at this issue at a very high level. One, I'll take your point on the African infrastructure needs of about 200 billion requirement for the next 6 years. Only half of that is met as of today. There is still a huge funding gap. But to Bobale's point, you're talking about the funding requirement is necessary. But what I really feel is it has to be top down. The approach has to be top down. When I say top down, it's the vision of the government has to be that, okay, we have to do this project in this country. Financing is a second aspect. Financing can be accommodated. There could be several measures, there could be several de-risking of the projects that can be done to get the financing, either from DFIs, either from private investors. Financing shouldn't be a big issue if the government has its vision to drive the project. That has been missing at a very, very high level point. On the secondary, with regards to financing, the projects have not been de-risked to the extent which they should have been in the past. There have been many success stories across African nations in the continent where the projects have been sufficiently de-risked in terms of political risk insurance have been, de-risked. Long-term infrastructure bonds have been done for several projects across Africa. But investors are selective when they want to invest in this project. So not many projects have been executed to the extent which they should have been. That has been the main reason why the infrastructure at this point is not to the extent that should have been.
No, excellent, thank you. And actually you bring a very important topic that others have mentioned, which is de-risking projects. No? So maybe, Besem, if we turn to you, from a de-risking perspective, what challenges do you see also on your side?
Yeah, thank you very much. So I'm from AFSIC. AFSIC is the Islamic Corporation for the Insurance of Investment Export Credit. This is the multilateral credit and political risk insurance arm of the Islamic Development Bank Group. We are a multilateral institutions, and we provide basically credit insurance and investment insurance in our member countries. In Africa, we're quite active. Usually, we tend to look at Africa like as if it's one set. But the reality is that really, even within the regions, in North Africa, countries are not the same. They don't have the same challenges. Same thing in West Africa and in other sub-regions. So it's going to be difficult really to identify like a challenge that is common across the board. However, if you look at the countries, some of them, for example, they have security issues. And this is where it's difficult for a government to invest in infrastructure where security is an issue. Some others, they have debt issues. Like they're highly indebted, they cannot really get into financing from traditional financiers, from commercial banks. And some of them also don't have the ecosystem for PPP projects. So there are many things that are really there as challenges for the countries. One of them also is basically related to the cost of funding. And the cost of funding, it has also to do with the rating of the countries, the economic situation of the countries, the perception of the risk in the countries. And this is where we can play a role. I mean, as a multilateral insurer, we can help into basically mitigate those risks and help also to make transactions, doable within a reasonable cost of funding. The other point is related to, I think, the thing that I see common probably across the whole. I mean, Africa is basically the gap or the financing gap in terms of infrastructure. I think there is still a need for more financing, and this is where, Bolia, you mentioned already about unlocking financial institutional investors to go into infrastructure, and this is where we want to put the focus more, is how to go into non-traditional type of investment and diversify the source of funding for this kind of projects.
Oh, excellent, thank you so much. Really, for all those views, I think there's a lot of overlap. We see some of the same challenges in Africa infrastructure development. Maybe if we now switch to a more forward-looking, probably a view of what are the possible strategies and solutions to tackle some of these challenges. Since we have ended on the de-risking point, maybe we can start with that. Some of the things that you are doing, some of the strategies that you are working on from your institution.
Yeah, so as I mentioned, we are there to support investment coming into these countries and Africa in general. There are investments that are supported by the sovereign, other investments that are really pure private or public-private projects. But in general, I think one of the things that we are considering now is to mobilize investment from institutional investors. And this is where we are trying to support banks, commercial banks who are financing projects in member countries, and then repack the whole financing into notes and these notes are issued to institutional investors, the pension funds and insurance companies who are looking for long-term kind of investment in these countries. So this is one way of us is basically to unlock investment. The other thing is partnership. I think partnership between, we are a DFI, and partnership within the DFIs with other MDBs, I think is key. And here I'm talking about mainly partnership in terms of guarantees and insurance. So we worked, for example, recently with the African Development Bank in one of the countries in East Africa, where we have supported work together with the African Development Bank. They have provided a partial risk guarantee, and we provided insurance. So basically, the blended rate for the country was very attractive, and the cost of funding overall for these kind of projects were very attractive. So this is something that we need to consider going forward. Last but not least is also cooperation with the regional DFIs. So regional DFIs, they have better knowledge of the countries there, the local economies. And I think what we are doing now is to try to support them by giving them access to affordable cost of affordable financing. So basically by providing insurance to banks who are financing these regional DFIs in member countries. Because of our high rating, this will enable basically the cost of funding to be at a reasonable rate.
Excellent. And fully agree with you. And I think my fellow panelists would also agree that partnerships are key. No? I don't think any one of our institutions can solve the problem. It's going to have to take those partnerships and take it to another level. No? And I think you would agree with that, Pradeep, in terms of partnerships with the private sector?
Yes, for sure. So I think, to Basam's point, the cost of capital is the key for in all of these things. Funding gap we're talking about is basically emerging from three angles. One is the funding from government. Second is it's the DFIs. Lastly, it's the private investors, whether it is debt or equity. Government's aim is different. It's their vision to get infrastructure is their primary motive. Vote bank politics. It's all their motive. The DFI's motive is more of impact. Forget about the returns for them, but it's more of creating an impact. But for private investors, there is no question it's a cost of capital. What is the return they're going to generate on their capital? That's their primary motive. Now, like I mentioned before, it's a function of, for them to participate in this project, it's a function of how de-risked the whole project is. What is their risk-adjusted returns is what they care about. That's the end goal, what they have in their minds. Now, there are several ways which we can tackle this issue. One is, like I said, PPP is one of the best way. We have got the Nairobi's Expressway example, where the PPP with the Chinese, Reconstruction Bank has been done with, the government of Kenya. That's a good example of how PPP can work. Another example is having a strong legal and regulatory framework. Yeah? If you don't have this, there are other businesses that come up. For example, having insurances to provide, which will increase the cost of the total projects. So having a strong regulatory and legal framework will basically reduce the risk for the investor. The Moroccan solar complex is a very good example again on how having a strong framework. Basically, what they did was they have got the tariffs done, land rights, and there are several aspects which they addressed for that project to go ahead. And again, they got a pretty good investor base. ACWA Power is the one that participated in that deal. So there are examples like that. So maybe I can give like 3 or 4 other ways of innovative financing. Long-term infrastructure bonds is one other example which we can consider. So there is no risk in the short term. We will not go after short-term commercial banks. Long-term infrastructure bonds would be pretty steady in terms of investors' return. They are visible, more steady. And the other example saying that having the political risk insurance, for example, MIGA, they provide this. But there is an inherent risk in it, which is that increases the project cost, which should not be onto the investor. Yeah? Either the cost of that insurance has to be borne either by the other parties, excluding the private investors, what I mean. So at the end of the day, these are some of the 4 or 5 good risk mitigation strategies. Blended financing is one other example, with DFIs and private and public funds that can come in. So governments and DFIs, if they can sufficiently de-risk the whole projects for the investors, this can be a great move forward for the African infrastructure.
Oh, excellent, thank you. Bowale, maybe let me turn to you, since Pradeep was also mentioning DFIs and governments. What do you see from the Africa Finance Corporation in terms of potential solutions to some of these challenges?
Yeah, thank you. I mean, I think a lot has been mentioned from the institutional perspective and the various forms of additional capital that can be raised. So I'll look at it from a project perspective, because I spent a lot of time sort of investing in projects in the energy and the transport and logistics space. And some of the tactics that we've employed is really looking at, in addition to the project development financing I mentioned earlier, is saying, okay, how else can we sort of fast track our projects and how can we de-risk projects? Of course, we look at things from a phased project development perspective. And so we try and say, okay, so if this project can be done, what is the pilot? And then how do we scale it? Not just in a particular country, but how do we sort of replicate it across various countries on the continent? And so one approach is really what we call the ecosystem approach, is to say, well, we have a port project, and you need the demand. You sort of need the demand, whether from the manufacturing or whatever the case may be. And so we then invest in interrelated projects, because we know that by doing so, the success of one project increases the probability of success in another project. And so that's one approach. The second is platforms. And so one of the examples that we have is the Arise Integrated Industrial Platform. We had the first project in Gabon, where we beneficiated the wood from the country. So we wanted to stop export of raw materials and to say, how do we go across how do we sort of add value to the products and then export a more refined and more transformed product. So we did that in Gabon with the Gabon Special Economic Zone. We replicated it in Benin and Togo with the agri-resources. So we have 3 projects under operations and 7 more in development in various parts of the continent. And so it's really saying, how do we de-risk and how do we invest in all these projects whereby we can replicate the success? In doing so, we're actually condensing the development process and timeline, as well as cost.
No, excellent. No, fully agree. Martin, we have, of course, discussed this in the past in several of the co-investments we have done together. And I think you have a lot of tools that you are working with in terms of addressing these challenges. If you could please elaborate on some of them.
Yeah. So what I hear a lot, and I'm going to probably repeat a couple of things, but it's all about creating an enabling environment for investment and laying the foundations to make that lending, that equity investment possible. So my comment would be a couple of things, right? So it starts with government. Government, create the regulatory and legal frameworks that make it possible to make that investment, create an enabling environment. Secondly, create programs. We have seen that across the continent. In Uganda, we had the Get Fit program. They're trying to roll that out in other countries. We had Scaling Solar, where actually a lot of work has been put into the preparation of project upstream support. Creating regulatory legal frameworks. The private sector can, comment on that. Do land acquisitions, do pre-feasibility studies, and put them out to tender. And what you will see is that the interest generally is there and the funding is there. Make use of all the funding that there is. Would be a third comment. We are a debt fund. We provide long-term debt capital in either hard or sometimes also local currency on the continent. But EAF is part of the Private Infrastructure Development Group. that group also provides guarantees through Guarantco, provides upstream and equity capital through the infracos, provides technical assistance financing in grant funding or viability gap funding. This is only a small suite that is available within the private infrastructure development group. You know, there are loads of initiatives like that. So the capital is there, and make use of it, and parties need to come together to develop these projects further. Governments, you know, buy land, allocate resources to it internally in order to create these programs. And once the programs are up and running, you generally see that funding will be available. Affordability is being addressed. It's often a problem. Blended finance, use it, you know. Only use it in cases where it's really needed. But that funding, there are pots available. Are they easily accessible? Not always, but life is not easy, right? Otherwise it would be rather boring. So use it at the project level where, in order to address affordability or viability. Use blended finance vehicles like us. You know, we are an A2 rated fund. And actually, we're an excellent way for institutional investors, for instance, out of developed markets, to access the infrastructure asset class, not directly, but they can do it through a platform like us, which is A2 rated, has a 20-year track record, and has a platform. And I always advocate that there need to be more platforms like the Emerging Africa Infrastructure Fund. And fourthly, make use of commercial bank debt that is available in the markets, as well as local currency solutions. Those pools might not be that deep, depends a little bit on market. But what you see a lot of these projects is still hard currency finance that creates a balance sheet risk for these governments, often when they have to provide indirect guarantees or affordability issues. So increasingly start to make use of local currency solutions locally, alongside hard currency solutions that are still available. And I think when we put our effort around these initiatives, things will happen.
Excellent, thank you. And thank you for mentioning local currency. Definitely that is something that we see in increasing demand, no, across the continent. Youngsik, we've talked also quite a bit about the de-risking, blended finance, of course, insurance solutions. You work with a lot with ECAs in your day-to-day work. What can be done? Do you see that as I mean, I can give you my view for sure. I do see an increasing footprint of ECAs already for a few years in the continent and these transactions. But it would be great also to hear some of the things that you are doing at Citi.
Yeah, absolutely. So earlier I mentioned that one of the key challenges in the developing of the infrastructure project is a high borrowing cost and relatively short-term maturity of the loan when the government, the sovereign, or corporate are trying to borrow to finance the project. DFI has been playing a critical role, as well as the multilateral, such as the AFC as a DFI, and AFSIC as a multilateral has been playing very important role in the financing of infrastructure project in an affordable financing solutions. And ECAs has been actively mobilizing billions of dollars in infrastructure, which made up of almost half of the Africa deals in the past decade or so. So export credit agency, they have recently updated what they call the OECD arrangement to offer a more flexible financing terms to sovereigns and corporate in emerging markets. So for example, ECA will be able to offer a 22-year repayment tenure for a climate-focused project. And they've also adjusted the premium they charge to the borrowers for very long-term financing solutions. So with the ECA support, the commercial bank like Citibank, we are able to offer very competitive financing terms to sovereign borrowers or corporate borrowers on a long-term basis. Could be 10-year to even 25-year or door-to-door tenure of financing to those borrowers when it comes to the infrastructure project. Like for example, CTV have arranged the financing solution with the support from the UK Export Finance, which is a UK government-owned ECA, for an expansion and upgrade of airport in Zanzibar for the government of Tanzania at a very attractive financing terms, and ultimately they will foster economic benefit for the island and creating jobs for the communities. So I mean, as I said, in conclusion, cost of borrowing is a big challenge for infrastructure project in Africa, and ECA and DFI solution could be one of the financing options that could provide the affordable financing.
Yeah, excellent. No, thank you very much, I think, for all those views. Maybe it's a good time, as just being conscious of time, if there's any questions. Yes, please. I think a microphone is coming to you.
Fiona Parrott-Humphrey from Rothschild & Co. I think the elephant in the room here is China. So China provides completely non-linked finance, very low interest rates. It has all sorts of other priorities in terms of why they want to develop infrastructure in Africa. So how do all of you who've just set out your stalls, and particularly the IFC with respect, who has very strict rules on lending to countries, how do you compete with the free and strategically driven finance that China is offering in infrastructure?
Yeah, thank you very much. Let me first check if any of my colleagues would like to provide a view first.
We don't really compete with that. So we only, typically what you see is it's government-to-government financing or different structures, and we only do private sector. So yeah, so we really don't compete with that. We look at private sector. You know, a government can have the option. You know, I either go with an offer that I got, perhaps from the Chinese bank, or you know, that comes with a certain package, or you know, go a PPP route with the private sector. I think the opportunity is big enough for us. You know, at least we are growing every year 10-15%. So we're happy with that growth rate.
Yeah, maybe I can answer.
Oh,
so I've seen that you're correct that the China. They've invested billions of dollars and lent quite a lot of money to many countries in Africa for the infrastructure project in the past 2 decades or so. Like for example, Angola, they had a huge debt from China for the development of infrastructure project in the country. But we have seen in the last 3 years that the Chinese support and the investment has decreased substantially in the region, and the other DFIs and ECA have stepped up to fill the gap. So I think it's more like complement each other, but it is quite obvious that we have seen that Chinese support has decreased substantially in the region.
Indeed. Bassem?
Yeah, maybe just to say that our status is a bit different because we are a multilateral institution, and the countries we're covering in Africa are member countries, so they're basically our shareholders. We don't intervene in terms of the countries from where they want to source the goods or to get financing. So basically, we don't intervene on that respect, but we deal with Chinese contractors. We provide even reinsurance to the Sinosure and the other ECAs in Europe. So on that basis, for us, the way we see it is that as long as the project or the financing is helping to serve the priorities, the development priorities of the government, this is something that we can support. And then we look at, of course, the conditions. We make sure that this is as per the best practice in the market. And for the government, if they have options, I think that's good for us, at least good for them and good for us.
Yeah.
Yeah. And from the IFC side, I mean, I fully agree. I mean, we're not really in competition with China. China is a shareholder also of the IFC and the World Bank. And again, governments and sponsors can make their decision who to get financing from. One thing that I can tell you that, and I think I've heard it from Besem, I believe, we do see EPC contractors from China in several of our transactions, Chinese equipment in several transactions too. We try, and this is my team from a syndications perspective, whenever also there is a Chinese component, we try also to bring in a Chinese lender into a transaction at the IFC standards, including on ESG. So again, it's not a competition. I think given the numbers and how much we need to move forward with in the agenda of Africa infrastructure, there is room for everyone. I'll stop there. I'm conscious of time, not sure, 2 minutes, not sure if there's another question. Yes.
Yes, I'll just squeeze it in. Michael Mills from the UK's International Climate Fund. We're part of the Department for Energy Security and Net Zero, and we work with our Foreign Office, FCDO, to provide the climate funds to emerging markets, including in South Africa's Just Energy Transition Program, the JETP, where in that one we're providing guarantees for the Africa Development Bank to increase the country headroom for South Africa by 2 billion, a big slice of South Africa's JETP. So from that background, it's a slightly technical question. We talked about partial risk guarantees and other guarantees. When you are on the panel are offering those, do you find that you're going to need a counter guarantee from the host government, and whether you bump up against country limits for that, and is that an issue, or do you find that you have sufficient takers for those partial risk guarantees?
I think Besem is.
I'm not sure I got it completely. There was the noise.
Oh,
okay.
If
so
you could repeat the question.
The question is, you provide a guarantee to cover whatever. If it's a political risk there, are you looking for a counter guarantee from the host government, and do you find issues with country capacity when you do that in general?
All right. Yeah. For us, I mean, I like the MDBs who are asking probably for this kind of counter guarantee. Our model is quite different. We provide insurance, and it depends. So there are projects that are where there is already the Ministry of Finance, for example, is the one who is borrowing, so there is no need for a guarantee. There are cases where the Ministry of Finance is the guarantor for the transaction because it's sovereign lending, and there are other cases where it's a pure PPP projects or private projects. In those cases, what we do is that we send a letter to the government requesting for their non-objection. So we just count on the non-objection from the government for us to support this project. This means for us this project is a high priority for them, and they want us to get involved. Capacity-wise, it's something that we assess, we look at, and but of course we do a lot of reinsurance on the back, so we manage somehow to get solutions for that. Thank you.
Excellent, thank you very much. And with that, I think we're out of time. I'd like to thank all the panelists. Thank you very much for your very interesting interventions. And thank you to everyone that has attended. I hope you have a great rest of the conference.
Thank you.